Great to be here at Montgomery Summit again, and a couple of familiar panelists from our panel last year, so I checked the tape to see if their predictions came true. Actually, Michael, last year we were talking about the IPO window. At the time it was in May, and there had been no IPOs for a while, and you said the earliest it could open would be late last year. Here we are in March, and it doesn't feel like the window's open. So
you are getting called out.
When do you think, when, I know no one knows for sure, but when do you think IPOs are going to happen?
Yeah, so window definitely did not open last year, as everybody in here would agree. I think the realistic answer, Katie, is it's tough for me to imagine the window opening this calendar year. Talking to a lot of companies, talking to a lot of the banks that are doing offerings, and I think folks are hoping for an opening Q1 of next year. So you might see companies starting to get ready, maybe making some confidential submissions latter part of this year with the goal of being ready to go out if the window opens in March, April for those companies. I think you'll see a few companies go out because they have to for whatever reason. RSUs expiring, options expiring, they need capital, they can't get it through the private markets. But I think by and large, window is, the best hope right now is Q1 of next year.
Jack, you have a lot of visibility into the IPO window through your job at the NASDAQ. So tell me what you're seeing.
Yeah, similar sentiment, and again, a lot of it is being driven by, again, the investor sentiment. And as we survey the buy side and a lot of the street, and I'm sure a lot of people in this room, a lot of people are bullish on the companies, on the stories, on the KPIs. They just don't know how to price things right now. And we saw that even today with Powell's remarks and kind of signaling for an additional rate hike, likely of 50 basis points in March, and the market reacted negatively. And so that just kind of delays when that potential window could open. Similar to Michael, as we're working with companies, private companies, there are a handful that are ready to go. I believe we could see a window with a few offerings as early as May or June. But these are also going to be companies at scale that have been on file for a while, confidentially, or a public S1 that are, to Michael's point, looking for a window because they need to. They feel that whatever that driver is from a board level, hey, we need to hit this window as soon as it opens. Do believe there may be a window late second half, but certainly not a large one. We think there may be, again, base case, kind of 4, 5 IPOs, again, at scale, larger revenue numbers, profitable story, large KPIs, and understandable business model. And then with the majority of those, then kick into 24 or later.
She's going to hold you to that, next year.
That's fine.
Next year I'm going to call you out if you're
I
wrong.
hope I'm wrong and that all of a sudden this thing rips, but I think there's a lot of us there.
So James, you're at the Australian Stock Exchange. Curious to learn about the IPO window there. What's going on down under?
Yeah, look, I think ultimately we're well integrated, of course, in the global capital markets, even though we're down under. And so we're seeing very similar patterns. 2022 was very tough. 21 was absolutely exceptionally good. We've got a few structural differences, though, in Australia. We have the world's 5th largest pension market, which is a great privilege, 2.5 trillion US under management in Australia, and only a country of 26 million people. So it's actually a massive tailwind for the equity market there. And so we tend to see a lot of support for listings across the board. The other feature of the Australian market is that we list smaller mid-caps. A bit like you did here in the late 90s, we can still do that. And that's partly because the market has grown up around junior mining companies listing 150 years ago. And that's translated quite neatly into other sectors like healthcare and tech. So the public market investors got a much higher risk appetite on average versus other major markets around the world. In terms of where we see the window reopening, I mean, it is very difficult to say. The Reserve Bank of Australia yesterday increase interest rates another 25 basis points to 3.6%. That we feel is sort of approaching peak inflation probably in the second half. And what we've actually seen is preparations for IPOs beginning now. So there are quite a number of processes already in place for the second half of the year. I should just mention, though, we still had 100 listings over the past 12 months. In 21, we had 240. So it was down. The average is about 135 over the last 5 years. But we've seen, so it hasn't been closed for junior mining companies or even mid-sized mining companies. So the mining sector almost has had a completely separate experience, and it's listing companies that are digging up tech-related metals like lithium and copper, of course, which are still in high demand. So we certainly see, broadly, second half things coming back.
And so, Amy, last year you were talking about how you deal with a lot with venture debt and companies that are trying to navigate what to do about their valuations. A lot of the valuations from 2021 were looking too rich. Are they still looking too rich? And what are companies doing now to raise the capital they need at this difficult juncture?
I don't think there's any surprise for me to say that valuations have come down quite a lot. So I guess what I can say to kind of reflect the sentiments here is we're an alternative to deciding whether you go public or not. We look to, in our group at CIBC Innovation Banking, we can do very early stage deals, but we do also focus on middle market and growth or late stage deals, and can put together venture debt financings that can ultimately extend the runway and hopefully give you the cash and the growth necessary to kind of get you to the next stage of whether it be hitting a milestone or just giving you an extra 12 months to hit that higher valuation that perhaps is being pushed out a little bit given market sentiment right now.
And it sounded like you were also predicting an uptick in M&A. Are you still feeling that way? It does seem like it's taken a while for buyers and sellers to agree on price with some companies. So do you think there will be more startup M&A this year?
We've definitely saw an uptick in M&A, particularly at the end of 2022. We're still visiting options for companies. I actually had one of my portfolio companies that we were just about to figure out additional financing to kind of supplement the acquisition that was going to take place. Interestingly, what happened was the target company's founder got a little bit uncomfortable with the earnout package that was going to be he would be on the hook for, and realizing with spend and pullback in the tech spending that maybe he might not be able to hit it as quickly as he'd like, and probably is going to push out the option of selling now. Might be better to sell it down the road. But that being said, I think there's a lot of opportunity for founders and investors alike to layer on some good quality companies, and I think there will be a rush of it towards the end of the year. I don't know, I think, guys, you're probably seeing a lot of sniffing around, I would imagine.
Yeah, I mean, Michael, you deal with a lot of startups figuring out next steps. Do you think M&A is the next step for many of them?
Yeah, I do think we're going to see an uptick in the M&A market, especially in the second half of this year. If the capital markets remain closed, so that's not a path to liquidity, then I think you're going to have a number of companies that last raised 2-3 years ago, and they have to figure out next steps. And certainly for later stage private companies, the fundraising market is very hard right now. It's extraordinarily difficult. That's why a lot of companies are turning to debt. I think what you're going to see, though, is a number of those companies decide that an M&A exit is the best possible outcome for them, rather than trying to fundraise a company that probably can't live up to its last valuation, even if it was 2-3 years ago, because the comps have come down. And so finding a soft landing via M&A is probably going to be their best path. And frankly, you have a large number of both private equity firms are extremely enthusiastic about software companies right now, and you have a large number of public company serial acquirers that have largely sat on the sidelines for the past few years because valuations were so high. And so you had private companies saying, gee, I could sell or I could go raise at 100x ARR, and they were taking the financing route. And so a lot of the big serial acquirers were sitting on the sidelines. They couldn't possibly pay those multiples and then explain it to their investors in the street. And now that the roles have reversed, you have a bunch of large public companies sitting on tons of cash, ready to buy companies now that the valuations have fallen. And I think you've had founders and management teams coming to grips with the new world order and accepting that the valuation they raised out in 2021 is frankly not the valuation in 2023. So I think you're going to see a lot of public company tech buyers aggressively jumping into the market.
Yeah.
So, I was going to ask.
I was just going to add to that, and then your question. But I think the other interesting thing, we're talking obviously capital markets and IPOs specifically, but the M&A is an attractive exit for a lot of companies. Like that's still a win for the companies, for the shareholders, and there's a lot of entrepreneurs that still thrive in those situations for those deals. Perhaps they're taking on that incumbent, they end up selling to them or a competitor, but that gives them, again, that runway to go execute on their vision and their roadmap. So it's an interesting dynamic because of the last few years in the capital markets where it was almost IPO or bust and it was very equity driven. But as we talk to a lot of founders, that is, again, a very successful exit for companies.
Do you feel that a lot of these companies are dual tracking though? I mean, I know in the past we've seen like App Dynamics sold at the 11th hour to Cisco the week they were supposed to IPO. I mean, that was unusual to be so last minute, but at least from what I've heard is that some of these companies that thought they were going to IPO, they're not sure how much longer they can wait.
Yeah, in my experience, I don't think we're seeing a lot of dual tracking right now. I think they're kind of single track. They're either looking at fundraising and trying to grow out of this to sustain to hopefully they're at scale when the window opens, or they're single tracking towards M&A. And I think a lot of people are, hey, the open sign is on if there's an offer. And I think everybody's going to be maybe not soliciting bids, but if somebody wants to talk and has something interesting, that they'll certainly take that conversation. I think boards are more open to that conversation as well, just looking at the options as well as the timeline that for each of these companies on a case-by-case basis.
Yeah, so we're seeing certainly that private markets are lending money, and then we're also seeing convertible notes to extend the IPO. So as opposed to dual track, it's actually just waiting out to do the IPO eventually, but at the same time looking at M&A opportunities. So we've had an enormous number of follow-on offerings actually, which is sort of around a 5-year high, which I don't think is necessarily the same. 5-year average, which is not necessarily the same here in the US. We were sort of number one by number of follow-on offerings over the last 12 months of any exchange in the world, and that's been really interesting because companies have been looking at relative value. So the private markets has taken a bit of time to catch up to the public market recalibration, but certainly those that have managed to execute M&A, so listed companies buying other listed companies, but also private companies as well.
And I think dual track listing really only works if going public is the first alternative and a viable path, right? Because the goal of a dual track is, hey buyer, this is your last chance to take us off the market before we're now public, and it's a much different regime there. And so, I think now running a dual track process and going to buyers and saying, if you don't do this, we're going to go public, the buyers might say, okay, we'll call your bluff, right? Yeah. So I think it's not a real good strategy in the current ecosystem on a dual track.
So there's dual track and then there's dual listings. James, explain to me why a company would list on the Australian Stock Exchange. You were talking about Block earlier. Maybe a US tech company. Why would they list there as well?
Yeah, look, there's dual listings and sole listings for our foreign companies. So we've got about 270 foreign companies listed on ASX. 50 of them are from the US. In fact, this time last year it was Block that dual listed after the Afterpay acquisition. So as part of that, Didn't necessarily have to dual list, but there's some real good reasons why the Australian market's important. And I think this goes for both sole and dual listings. As I mentioned earlier, we list small and mid-cap companies. So, what we see in terms of valuations is with that demand, particularly from the growing superannuation or pension market in Australia, we see a sort of underlying demand and those tailwinds for earlier stage companies. And when I talk about earlier stage, I'm sort of talking about sort of $5 billion market cap at IPO and below, and anything upwards from about $200 million market cap post-money. And so what you're getting there are valuations feeding through that tend to be at a premium to other major markets around the world in that zone, partly also because of index inclusion. So you can get into the major indices in Australia at about sort of $800 million market cap, whereas the equivalent index might be the S&P 500 here, which is a sort of $12 billion entry point. So if you're getting into those indices, they're S&P indices as well, the S&P ASX 200 and 300, you're getting into those indexes quite early. You're getting that attention at an early stage. The other aspect, of course, is the support, the post-listing support, analysts and investors looking at your stock over time, which is a network that's grown up, as I say, from sort of 150 years ago, supporting junior miners. It's something we're very used to doing in the Australian context. And I think the third sort of thing is regulation. We have quite streamlined regulation, particularly for things like follow-on offerings that can be done within 2 days. Very low doc offering documents, very streamlined process. And in terms of the initial listing itself, we don't have things like Sarbanes-Oxley and so on. We do have risk management practices, but it's certainly less stringent than say, the US markets in terms of coming to the boards.
So in terms of the U.S. market, Jack, a lot of the companies that went public in the last couple of years, unfortunately, haven't traded that well, especially tech companies. And so I've been hearing about a lot of take private rumors. I mean, what do you think is going to happen to a lot of these companies? I know the NASDAQ, last I checked, was up year to date. So, but I mean,
Yeah,
But-
so I think each company's going to look at, again, the operations right now, whether it's private or public, right? And I think there's a lot of companies actually that were planning to go public that are actually happy right now that they're not public and they're being able to do their restructure, they're being able to kind of assess their expense and what that burn looks like in the private markets versus having to do this in the public sphere. Because if you miss that quarter or two, you get heavily penalized in the public markets. And so I think we're continuing to see good companies beat and raise and do well in the public markets, but everybody's having to really pull down their guidance for this year. I think that's a lot of the reset the buy side was looking for coming off the Q1 earnings was what are they projecting for the rest of the year, and is that attainable? And so I think we discussed M&A. That's certainly going to be an option, especially for a lot of the software companies. And then I think what we'd like to see before the window opens, we'll likely start to see follow-ons and start to see how those begin to trade, what the receptivity is from the buy side, where they're priced, how they're subscribed, oversubscribed, et cetera, similar to an initial public offering. And then once we have that data points, we'll be able to, again, get a better have a feeling for price for the new issuance coming out later in the year.
Amy, last year you were concerned about the possibility of a looming recession. Are you still worried about that and other macroeconomic concerns?
Do we get in one or not? I think we were all discussing that prior to this. I think it's somewhat here. And so what we discussed last year was companies contemplating that the market doesn't get better and maybe having a plan, like a bear plan for their businesses. And so what we do encourage, because buyers too are triaging between all of these companies they're looking at. They want to ensure that the businesses are careful with their capital. I have a company, one of my portfolio companies, that joked that the same investors he was talking to last year who were telling him he was spending too little are telling him now he's spending too much. And So he has to accommodate investor sentiment in his future budget and plans so that he makes everyone happy when he decides to either do another equity round financing or go public. And so I kind of echo what I said last year. You got to have to have a plan. Because for some of our companies are doing very well. Say if you're in security, for example, a security software company is doing very well right now, and but the alternative is not so good, and if you need to pivot quickly, I'd like there to be a plan. And so when we talk to companies, the way we triage the companies we talk to like who's the pre-existing sponsor here, and like how close are you with your sponsor, and is there a clear path for growth, and maybe how else can you kind of, are there different avenues for growth that you can add on? But most important to me are the sponsors giving like really sound advice? Are they listening to their board? Because it's really important. We all know that entrepreneurs fly very close to the sun and sometimes take a little bit longer to respond to market changes. And so I really count on sponsors to be pushing them as I'm pushing them, cut back, protect the enterprise at all costs, and be careful that you have the runway necessary to kind of get us. And what I want to do is help that business to get them out of this market so that when they raise the next time, they can do it at that attractive valuation level that they hope to do.
I would say there's the fundraising market isn't closed by any means, right? There's just a flight to quality, right? And I think everybody would agree that over the past few years, the market was overseeded, right? There are a number of companies that got fundraising that probably should not have gotten venture capital fundraising, right? And it's the fourth and fifth challenger in a market. And so you have an overseeded market, and what you're going to see is the investors really focusing on the quality companies. And so those companies are still able to raise capital. Valuations have changed, but it's every investor I talk to, no one's shut down for business, right? Everyone is looking to make new investments. They're just doing it a little more thoughtfully, with a little more time, because it's not, the company has a term sheet, and if you don't agree to a term sheet in 24 hours, they're going to take the other one on the table, which everyone lived through in 2020 and 21. So you have time to make more thoughtful decisions, and investors are being more careful, doing more diligence, and really focusing on the top companies in a space, as opposed to seeding the fourth, fifth challenger, which I think we saw a lot of.
And last year you predicted there would be more tech layoffs. Unfortunately, that prediction came true. But thank you so much. It was great to get all your insights, and look forward to checking your predictions next year.
Thank you, Katie.
Thank you,
Katie.
Katie.